What you know. I'm so curious these days how you're thinking about the economy.
Well, I think people that are investing in individual stocks, it's sad they're careful when they buy a refrigerator or an airplane flight. They're careful with their money, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So you really got to be careful. Look at the company, look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason.
G'day everyone. Today we're going to be diving into some quotes from Peter Lynch's book, One Up on Wall Street. You may have heard only roughly 10% of fund managers beat the S&P index fund after their fees, and anywhere from 80 to 97% of retail traders actually lose money. Because of this, a lot of the common advice is to avoid picking stocks and just to invest into the S&P 500 or any other index fund.
How to invest, don't make it any more complicated than it is. Own the stock market and own the bond market.
What we teach is to invest in good mutual funds. It's what I have done for 40 years and what Anthony does and what all of us here do.
Now, the first and something I advocate nonstop here in the channel is, wait for it, index funds.
This advice is sound for someone who does not like the ups and downs that come with the stock market or the homework required that needs to be completed in order to understand the business that you may like to invest in. Peter Lynch believes that we as everyday retail traders can not only beat the professionals but also the S&P 500 index fund. I tend to agree with Peter Lynch on this statement, and as we go through his quotes, we'll break down as to why this information is relevant to us as a retail investor and why it may not be as difficult as it may initially seem. The first quote we're going to be diving into on Peter Lynch's book, One Up on Wall Street, is one that is very early in his book. Stop listening to professionals. 20 years in this business convinces me that any normal person using the customary 3% of the brain can pick stocks just as well, if not better, than the average Wall Street expert. As people in the general public, we are constantly interacting with businesses to meet our own needs and desires. If you are constantly exchanging your money to obtain a business's products or services, chances are you and other like-minded people enjoy being a customer of theirs. Because you constantly shop there, you know their products, their reputation, and maybe even some news about them. This knowledge is not knowledge that can only be attained by a stock market professional. This knowledge can be attained by your mum, your dad, your brother, or your sister. If you buy a good business, that business will grow, and so will its stock price. If you buy a bad business, the stock price will fall, and your shares won't be as valuable. If you don't know what you're buying, you don't know whether it's good or not.
Well, it bothers me that people are very dangerous when they invest. This word "play the market," that's a dangerous term. But if you do some work, do some research, know what you own, look at the research, look at the balance sheet. If you could add 8 and 8, get fairly close to 16, you can find out this company has lots of debt, no cash, they're in trouble. You should know it.
This next quote is very similar to the previous quote and is a little bit of a dig at Wall Street. So let's just have a read through it and let's see if we can learn anything extra from this quote and maybe provide us with some more further guidance. There seems to be an unwritten rule on Wall Street. If you don't understand it, then put your life savings into it. Shun the enterprise around the corner, which can at least be observed, and seek out the one that manufactures an incomprehensible product. There sometimes seems to be a tendency for Wall Street investors to chase after complex companies rather than just trying to find companies that are understandable. They might invest in these companies because they look cool and exciting and it looks great for their portfolios, but ultimately if these businesses are not making money, the businesses is no good and it's not going to be any good for the stock price. I'm not going to be listing any specific funds or fund managers, but if you have a look at some of the fund managers' picks that there might be, you might think, do they actually know this business? Do they actually know what they're investing in? If you've got any doubt, you can typically just look to see whether they've actually worked in the industry or not. Chances are if they haven't worked in the industry and it is a very complex industry, chances are they're just picking this stock because it's just sounds cool, not necessarily because it's any good. This next quote from Peter Lynch's book is one of my all-time favorites, and it shows how simple investing can be and the importance of not trying to overcomplicate investing. If you can only follow one bit of data, follow the earnings. Assuming the company in question has earnings, as you'll see in this text, I subscribe to the crusty notion that sooner or later, earnings make or break an investment in equities. What the stock price does today, tomorrow, or next week is only a distraction. The meaning behind this quote is simple. Too many people look at random items on the financial statements and as well as looking at other key metrics. Although these metrics are important and they do paint a picture, they only paint a small part of the picture. Ultimately, what we're looking for is earnings. Peter Lynch's overall arching statement here is, if you could only look at one item, look at the earnings. The earnings is going to tell you a lot more about how the business is operating and whether this business is likely to continue to be successful or not. Another quote that I like from One Up on Wall Street, which shows how simple investing can be, is stocks aren't lottery tickets. There's a company attached to every share. Companies do better or they do worse. If a company does worse than before, its stock will fall. If a company does better, its stock will rise. If you own good companies that continue to increase their earnings, they'll do well. What Peter Lynch is saying here is strong companies that grow their profits tend to have their stock price grow as well. And over time, the opposite is true for struggling companies. This means we need to do our research and invest in good businesses with solid earnings growth. A lot of people tend to invest in companies for a number of reasons. Sometimes people invest into stocks just because they think the price will go up, or sometimes their friend thinks this company is the next big thing. What Peter Lynch is stating here is this kind of thinking is very dangerous for an investor. An example of this is the dot-com bubble. A lot of companies' market caps were blown way out of proportion for a number of reasons. People were buying these stocks just because the price was going up and there was no other reason behind it. Ultimately, there was no proper decision making or proper thought process behind the purchase of these stocks. These businesses were not even making a profit, and people who invested into these companies like lottery tickets, a lot of their savings got wiped out, and unfortunately they were not able to get those savings back. This next quote is a very important quote to think about when one of your great businesses has dropped 5% in price. A price drop in a good stock is only a tragedy if you sell at that price and never buy more. To me, a price drop is an opportunity to load up on bargains from among your worst performance and your laggards that show promise. This refers to a situation where a company with a solid track record experiences a decline in its share price. A price drop itself isn't necessarily bad. It only becomes a negative event if you panic sell and sell your shares at the lower price. A price drop can be an opportunity to buy more shares of this company at a discount. This is like getting a sale on a high quality business. Peter Lynch is saying here, if you have a great company and its stock price drops, buy more. You will be able to get a discounted price. And if your analysis is correct, your percentage of returns on investment will be much more significant instead of if you just sold this company and just did not buy any more shares. A perfect example of this is the airline companies during the COVID-19 pandemic. A lot of these airline companies hit all-time lows due to the minimal amount of travel that was occurring and fears of bankruptcy. Ultimately, the airlines had strong enough balance sheets and received large enough bailout packages to survive the pandemic quite easily, and it did not diminish people's desire to travel by plane. Taking into account Peter Lynch's advice, how can we invest in businesses that are profitable and are also desirable? Seeking Alpha will allow us to review businesses that we interact with on an everyday basis. Referring back to the video, we can also review the income statement for the businesses that we have an interest in. If we see these businesses are profitable and their earnings are growing and they are not necessarily diluting shareholders and they aren't borrowing a bunch of money, chances are this business may be something that you may like to invest in. Ultimately, this is up to you what you would like to do with your money, because it is your money at the end of the day, and I'm not a financial advisor, and I don't necessarily want to influence your decision in any way, shape or form. If you are interested in using Seeking Alpha, I have an affiliate link at the bottom below. They will be able to give you a discount in your first year and help you get started. Till then, I'll see you in the next one.